This is a very simple chapter, but again, very important. So this is an account that measures how much foreign currency comes into India and how much foreign currency goes out of India. It tracks, it's basically an account which tracks this. Okay, so by definition, it is a record of economic and financial transaction with the rest of the world. Economic transaction with the rest of the world over a period of time. So it is a systematic accounting record, okay, of all economic transaction that happens between the resident of the country and the resident of foreign country. Okay, in simple words, it is a tracking mechanism to determine how much money is coming to India and how much money is going out of India in terms of foreign currency. Is that okay? Yes. So it has got mainly three things that is tracked. One is your current account, capital account, and foreign exchange reserves. Okay. The other one, errors and omission, is part of any accounting process where there is changes that happens after, okay, the accounting process. Let's not worry about that. Okay. So what is this current account? So it tracks all current transactions. It tracks all current transactions. Okay. So it includes export and import of goods, export and import of invisibles. So goods, when it is exported and imported, when it is exported, dollars comes into India. When it is imported, dollars goes out of India. So export and import of goods, export and import of invisibles. Now invisibles includes something which cannot be touched and felt, tangible. Goods are tangible. These are not tangible, non-tangible things, invisibles. So there are current transactions which are, current means immediately exchange happens. When you give 100 rupees, you get 1 kg mango, immediate. So that is current transactions. So export and import happening immediately. Here also services. Okay, I mean, but it's not the definition, TK. Just for your understanding, it's not the definition. Any current transaction. So invisibles includes services. Okay, includes your payment on international investments, meaning profits, dividends that you get. That is the example of payment on international investments. Are you understanding? See, let's say you invest and buy a house in US. Okay, the investment is capital account. I'll come to that. Once you have invested, let's say you are getting rent on a monthly basis from US. So it is payment on international investment. Or let's say you have purchased shares in US. So you are going to get income from that. You are going to get dividend from that. So those are part of payments on international investment. Except example, you can write profits. Then transfers representing one-sided transaction. That means there is no return, there is no exchange. One-sided transaction. Example, remittances, gifts, grants. They are transfers which represents one-sided transactions. Now, balance of trade records export and import of goods. So export and import of goods is balance of trade or trade balance. So current account includes trade balance and net invisibles. Net invisible means outflow and inflow other than net, right? So export and import of goods gives you trade balance. Net invisibles is invisible payment and invisible receipt. So 1 plus 2 is balance of payment on current account. Balance of payment on current account. So balance of payment on current account can be surplus or it can be deficit. In India, for example, it is deficit. So this is current account. Next is capital account. So any other transaction other than the current will be recorded in capital account. Okay, so capital account includes mainly investments and external commercial borrowings. So investments means they are non-debt creating. You don't have to repay it back. The economy doesn't have to repay it back. Okay, debt creating means external commercial borrowing where the money has to be repaid back. It is coming now, but it has to be repaid with interest. So non-debt creating includes your foreign direct investment and foreign portfolio investments and any other asset holdings, India's subscription in international institution, quota, etc. All of that are non-debt creating. Meaning when we keep money in foreign international organization like IMF and all that, it's like a club where we have to give money as subscription amount, like any club. If you want to join a club, you have to pay subscription amount. Same way, if you want to join IMF, World Bank, etc., you have to pay subscription fees. Is that okay? So India subscription in international institution, quota payment, etc. Okay, so foreign direct investments, then your portfolio investments, then your foreign asset holding. I'll explain everything. Foreign direct and foreign institutional or foreign portfolio investment, all of that I will explain. Okay. Then any foreign asset holdings by banks, whether Indian banks holding assets abroad or foreign banks holding assets here. Debt creating mainly your external commercial borrowing, then NRI deposit or any other liability taken by the banks. Okay, so that is your current account and capital account. So having understood that current account and capital account, answer this C. Okay, both. Okay, now, okay, let this only be there. Now also both. What is capital account? So capital account is basically investment or loan. What is current account? Export or import of goods and services, etc. So when you buy goods, what are you doing? Importing. When you buy a bike, you're importing what? When you buy a ship, importing goods. When you buy gold, importing gold. Yes or no? So you got confused because the word capital is mentioned. This capital is different. That capital is different. This capital. Capital account includes what? Investments and so this is nothing but import of goods. Import of goods. So what's the answer now? 2 only. Online students, did you understand? Yes. So purchase of capital goods is only to confuse you. Whether it is consumer goods, whether it is capital goods. Remember when we did the first class, I gave you definition of capital. In this case, capital goods is something which can be used to produce something else. Whether it is consumer goods or capital goods, import is import of goods. So import of goods is current account. So this statement is wrong. I hope you understood. So this is something which you should be able to appreciate. That's all. Even in the exam, these are the things that goes wrong. Not that you wouldn't have studied or not that you don't have the knowledge about that topic, but you fall for the trap set by the examiners. Okay. And the third part of balance of payment is what? Your cash reserve or forex reserve, called as cash account or official reserve asset account. Official reserve assets account. So it is nothing but your forex reserve. So in India, who maintains forex reserve? RBI. And RBI maintains this forex reserve in 3 forms. What is that? Gold, foreign currency, and another international currency which is called as special drawing rights, SDR. So when there is a surplus in our balance of payment, that surplus is transferred to this reserve. When there is a shortage, we'll have to use from this reserve. Further, when we don't have this reserve, we'll have to borrow that money because balance of payment is a double entry system and it can never be not balanced. BOP always has to be balanced. Okay, because it is a double entry system, BOP has to always be balanced. Inflow should be matched by outflow. Otherwise, there is going to be a shortage. Okay, otherwise there is going to be a shortage. Okay, that shortage has to be matched by our reserves, met by our reserves. When we do not have reserves, like how Sri Lanka doesn't have its reserves, it has to borrow money. Is that understood? Right. So Sri Lanka's reserve drops to 1.93 billion in March. So this is the problem when we do not have enough reserve. So when we discussed it in fiscal policy, where I said that we need to maintain reserves and we cannot use it to meet our fiscal deficit. So why do we need reserves? Look at this. It owes $8 billion payment, okay, this year, but it has a reserve only of 2 billion. All others leave, import and all you leave. Okay, they have a loan that they have to repay. So that means they have defaulted on their sovereign guarantee. Understood? So they are not able to repay back that money. So this situation where there is imbalance between the inflow and outflow is called as balance of payment disequilibrium. So balance of payment is a double entry accounting record. It must always be balanced. So balance of deficit of surplus indicates imbalance in BOP. Surplus is not a problem. Okay, because when there is a surplus, we will increase our reserves. But when there is a deficiency, then we have to meet that through our reserves. So what is balance of payment disequilibrium? When autonomous receipt is not equal to autonomous payments. Autonomous receipt is not equal to autonomous payment. It is called as balance of payment disequilibrium.